Okay, so we are looking at a pretty ugly implied open this Wednesday morning.
Hmm.
I mean, software and AI stocks took a $300 billion hit yesterday.
That's the number. A massive wipeout.
And just looking at the pre-market heat map, it uh it doesn't look like the bleeding is stopping. It's February 4th, 2026, and the big question is this just a correction or is this something more fundamental?
Well, looking at the strategy briefing we have in front of us, the analysts are calling this the macro
A
crossroads.
macro cross
Yeah,
rate.
and it's not just, a bad day of trading. We're seeing a collision between a huge reality check in AI and a sudden, sharp repricing of risk in the broader economy.
A crossroads implies a choice, but right now it feels like everything is pointing down. I'm looking at S&P futures, they're basically flat. The Nasdaq is heavy. VIX is at 18.5. It just feels fragile.
That's very fragile.
So the mission for this deep dive then is to unpack these institutional notes we have, the bulls, bears, and the bell report, and really figure out where the money is actually going. Because if it's leaving tech, it has to be going somewhere.
Exactly. And for a lot of our listeners, the gut instinct is to assume, okay, if stocks are falling,
You buy bonds.
you buy bonds,
Yeah.
right? The classic flight to safety. But this briefing explicitly warns that today, that might be the single most dangerous trade on the board.
The pain trade. Okay, we are definitely going to drill down on that. I think a lot of retail investors might be walking right into a trap there.
No question.
But let's start with the catalyst, the crime scene, if you will. Yesterday's wipeout wasn't just random. The source material points directly to a release from Anthropic.
It does. It's the release of their new cloud application layer. And to understand why this is tanking the market, you have to get that this is not just a smarter chatbot.
Right, because we've seen better chatbots before and the market didn't blink. Microsoft is down 3% pre-market. Nvidia is down. Why does one software update cause a $1 trillion repricing?
It's because of what that application layer actually does. I mean, until now, AI generated text, it generated code, but you still needed a human to take that output and put it into another software tool.
You needed Asana, you needed Salesforce, something to manage the workflow.
Exactly. Anthropic's update, it automates the execution.
So wait, instead of me asking the AI to write an email and then I go open Outlook to send it, the AI just handles the entire communication flow.
It handles the entire thing. And if the AI can manage the workflow, the database, and the execution, investors are suddenly asking a very scary question.
Why do we need the expensive subscription software in the middle?
Precisely. The briefing calls this AI disruption 2.0. It's the moment the market realized AI might not be a tailwind for all software companies. For some of these legacy SaaS players, it might actually be the predator.
That's the distinction. I mean, for 2 years, the entire narrative was AI helps software companies make better products.
And now the narrative is AI makes software companies obsolete.
And that is why you see Microsoft and Nvidia dragging down the whole Nasdaq. It's pure valuation gravity.
It is. I mean, investors were pricing these stocks for absolute perfection through 2030, assuming they would just own the future. But if their core business models aren't defensible against this new wave of automation, well, those future cash flows just disappear.
So that 3% drop isn't just panic.
No, it's a recalculation of the terminal value of these companies.
But okay, let's push back a bit. We've heard tech is dead a dozen times in the last 5 years. Is the market overreacting to a single product launch from one company?
It's one company, but it's the proof of concept. It proves that technology is ready and the market absolutely hates uncertainty. So when you combine that existential dread in tech with what's happening in the real economy, you get this massive rotation.
The move from bits to barrels.
That's the one.
Which brings us straight to the energy sector. This is the part of the briefing that really jumped out at me. I mean, while tech is melting down, Exxon Mobil ticker XOM is gapping up almost 4% pre-market.
Which is a huge move for a company that size.
And usually when we talk about a rotation to safety, people think consumer staples, maybe utilities.
Right.
Why is oil the hot trade in 2026?
It's two things, geopolitics and hard cash. First, the briefing highlights a major geopolitical shift. There's a new trade agreement mentioned where India has agreed to halt its purchases of Russian oil.
Wow, that's a huge deal. India was one of the biggest buyers keeping Russian crude on the global market.
Correct. So if that supply is effectively cut off, the global market gets much, much tighter. And suddenly, the demand for U.S. source barrels just skyrockets. So that's the geopolitical tailwind.
Okay, but the reason Exxon is surging isn't just luck, right? It's their internal strategy.
It's the internal strategy update they just released, the cost reductions in the Permian Basin.
They're pumping it cheaper.
They're not just pumping more oil, they're pumping it so much cheaper. They have managed to lower their break-even price significantly. So you have a scenario where the price of your commodity is rising because of scarcity.
And your cost to produce it is falling because of efficiency.
That is a cash machine thesis right there.
Right.
The note puts it perfectly. In a world where AI profits are speculative and maybe 5 years away, investors want companies that are literally printing cash today. Exxon is positioning itself as a growth defensive hybrid.
It's a flight to reality. Show me the money right now.
Precisely. And the levels to watch here are pretty clear. The bull case target for XOM is 145. If it breaks that, you could trigger a wave of short covering. The bear level is 135.50. If it drops below that, it was just a pop. But for now, the momentum is with the boring stuff.
Speaking of finding winners in a tough market, I want to pivot to healthcare, usually another defensive sector, but the notes describe what they're calling a civil war in the weight loss drug market, a big divergence between Novo Nordisk and Eli Lilly.
Yeah, this is where stock picking matters so much more than sector picking. You can't just buy a healthcare ETF today and hope for the best.
So let's start with the loser. Novo Nordisk is sliding, down 4%. I mean, everyone I know is talking about these GLP-1 drugs. Demand seems to be off the charts. How are they losing value?
It's not about demand. It's all about pricing power. Their guidance for 2026 was just incredibly soft. They actually cited unprecedented price pressure.
And what does that mean in practice? Is it insurance companies finally pushing back?
It's a combination of that, yeah.
What?
Insurance companies demanding lower costs and, frankly, increased competition, forcing them to discount just to keep market share. The market's looking at Novo, and the fear is that we've already seen peak profitability.
So they're selling as many units as they can make, but they're making less profit on each one.
Exactly. The margins are getting squeezed.
Okay, so Novo is getting squeezed, but Eli Lilly is the opposite story.
Lilly is showing massive relative strength. They're reporting earnings soon. Consensus EPS is $2.66. That's up 23% year over year. But the real story, the thing the market is betting on, is the supply chain.
So Lilly has actually solved the logistics. They can get the pens to the pharmacies without slashing prices.
That is the bet. It's a battle of pure execution. The options market is pricing in a huge move today. Lilly implied volume suggests a 6.5% swing.
That is wild for a mega cap pharma stock. What are the key levels there?
The bull case breakout target is $1,113. If they hit that, it confirms they are the undisputed king of the weight loss hill. The downside risk, though, is $977. If they miss or show that same margin compression as Novo, that stock has a long, long way to fall.
It really feels like execution is the theme of the day. Whether it's Exxon in the Permian or Lilly's supply chain, the market is rewarding companies that can actually deliver.
Not just promise. And that is exactly why the macro picture is so punishing right now. Valuations are being compressed by what this report calls the double-headed headwind.
Okay, that sounds ominous. We're talking about yields and the dollar.
We are. The 10-year Treasury yield spiked again this morning to 4.28%. We are now approaching a 5-month high.
And I want to pause here for a second. We talk about yields a lot, but let's just make sure everyone gets the mechanics. Why does a 4.28% yield specifically crush a company like NVIDIA or Microsoft?
It's all about the discount rate.
Yeah.
A huge chunk of a tech company's value is based on money they expect to earn 5, 10 years from now, right?
Right. Future earnings.
Well, when the 10-year yield, which is the safe return you can get from the government, goes up, the value of that future risky money goes down.
So if I can get almost 4.3% risk-free from the government, why would I take a risk on a tech stock unless it offers a massive return?
Exactly. The hurdle rate gets higher. As yields rise, the present value of those future AI profits shrinks. It is not a feeling, it's a formula. And then you add the dollar index at 97.4. A strong dollar just kills the earnings of U.S. tech companies selling overseas.
So valuations are shrinking from yields, and earnings are shrinking from the dollar, the double-headed headwind.
And this volatility is being amplified by what they're calling the data void. You know, we just came out of that 4-day government shutdown.
Right, so we're missing key data reports that got delayed.
We are. Investors are flying blind. And when investors are blind, they sell first and ask questions later.
Okay, this leads us to what feels like the most critical warning in this entire briefing, the pain trade. You said earlier that buying bonds right now, it's a trap.
The section is literally titled, What Retail is Missing. And it's a stark warning.
Yeah.
I mean, usually stocks go down, bonds go up. They act like a seesaw.
A hedge.
Right. But today, we are seeing Sell America Incorporated. Stocks are falling, and bonds are falling right alongside them.
So if I buy a long-term treasury bond ETF, hoping to hedge my portfolio, I'm actually losing money on that position too.
You are catching a falling knife with both hands.
Why is the bond market broken?
It comes down to supply and the OBBBA.
The One Big Beautiful Bill Act. I know the name sounds ridiculous, but the spending implications are dead serious.
The name is just marketing. The mechanics are just math. This bill authorizes massive new federal spending. And to pay for it, the Treasury has to issue a flood of new debt, new bonds.
The supply glut is coming.
A massive one. The market knows that starting next week, the Treasury is going to flood the market with new paper to fund all these OBBA projects. When you drastically increase the supply of something,
The price goes down.
the price of bonds goes down. And when bond prices drop, yields go up.
So investors are demanding a higher interest rate, a higher yield to soak up all that new debt?
Exactly. So even though tech is crashing, which usually drives people into the safety of bonds, the deficit spending is scaring them out of bonds. There's simply nowhere to hide.
That is a tough pill to swallow. I mean, if you can't hide in tech and you can't hide in bonds, where does that leave the S&P 500?
It leaves us in what the briefing calls a liquidity trap. The S&P is just churning in a tight range between 6,800 and 7,000.
And they call 7,000 the line in the sand.
It's a brick wall. The institutional flow data in this report is crystal clear. Smart money is actively selling every single time the market rallies near 7,000. They are using retail optimism to offload their positions.
So as a trader, I should not be chasing a breakout above 7,000 today.
Absolutely not. The advice is to fade that rally. Until we get a daily close above, say, 7,050 with significant volume, any move up is probably a head fake. The market is stuck.
Okay, speaking of things that could move the market, we have one more specific name to cover before the bell rings. Uber.
The consumer resilience bellwether.
Why Uber? Why is Uber the proxy for the consumer and not, say, Amazon or Walmart?
Because Amazon is stuff you might need. Uber is stuff you want. Rides, food delivery, these are conveniences, right? If the consumer is truly broke, or if inflation is really biting, the first thing you cut is the $20 salad delivery.
That makes perfect sense. It's a pure check on discretionary spending. What are we looking for in their numbers?
Well, the options market is implying a huge 8% move, so get ready for volatility. Investors are watching two things. The take rate, so how much cash Uber actually keeps from each booking, and of course the robotaxi timeline.
We just can't escape the AI narrative, can we?
It's everywhere. If Uber can show they're successfully integrating autonomous vehicles, they stop being a taxi company with thin margins, and they start being a tech platform with software margins.
What are the levels to watch for that 8% move?
The bull level is 87.50. If they clear that, it signals the consumer is healthy and the tech transition is on track. The bear level is 74.50. If they lose that, it suggests the consumer is finally tapping out.
Okay, let's try to synthesize all this. It is a chaotic morning. We have Anthropic disrupting the entire SaaS model. We've got Exxon surging on geopolitical scarcity. And we have a bond market that is refusing to act as a safety net.
It's a moment of repricing, a big one. We're moving from a market that was fueled by cheap money and, vague AI promises to a market that is demanding hard execution and real cash flow.
So for you, listening and staring at your terminal right now, what is the one data point that matters most today?
You have to watch the ISM services print later this morning.
Why that specifically?
Because the service sector is where the inflation has been so sticky. If that number comes in hot, showing strong growth, high prices, it's going to push yield even higher. And if the 10-year yield breaks 4.30%,
that double-headed headwind becomes a hurricane.
It becomes a hurricane. Tech will get crushed, and that rotation into energy will accelerate hard.
It is going to be a fascinating session. So keep your eye on S&P 7,000. Don't get baited into a false rally. Watch Exxon as that defensive growth hybrid. And for the love of your portfolio, understand what you're buying if you step into the bond market today.
And I'll leave you with one thought. We spent the last 3 years obsessing over the digital world AI software, the metaverse. But today, the safest money is flowing into oil barrels and pharmaceutical supply chains.
The physical world is striking back.
Maybe. I mean, if the digital world is being disrupted by code that literally writes itself, perhaps the only defensive moat left is owning things that are real, heavy, and hard to move. Maybe the boring economy is the only safe harbor left.
A sobering thought for a high-tech world. Stay sharp out there, watch your levels, and good luck. See you at the closing bell.